Welcome Web3 CEOs and CFOs. Are you diving into the world of digital assets and cryptocurrency and are starting to worry about how you're going to manage the tax implications associated with your transactions? If that's the case, this video is for you. We're going to go over all of the intricacies and considerations for a Web3 business when it comes to taxes. So the first question that you may be asking yourself as a Web3 business is, why do I even have to file taxes? You may hear things about transactions on the blockchain not being taxable or the IRS not being able to trace them. Let me assure you, this is far from the truth, and of course we don't suggest that approach. And there's many risks to not filing your taxes. First of all, it is the law and you're required to file your taxes. And if you don't, you can face both civil and criminal penalties that can come with not just potential jail time and criminal sentences, but very significant interest and penalties and stress associated with tax notices and audits if you are not compliant. Additionally, there's cash flow risks associated with this. If you're not compliant and you receive a tax notice for an unexpected tax bill, this is going to hurt your business's bottom line. It's going to hurt your cash flow. It could even potentially impact your business continuity. So again, I want to remind you, when you're transacting on the blockchain is an immutable public ledger. That means that when a transaction is recorded on the blockchain, it basically can't be changed, and it's going to be there in perpetuity. And this works in the favor of the IRS and other tax agencies, because all they have to do is link your identity to the transaction, to the wallet making the transaction, and then you're going to be on the hook for the taxes to do that. So, how does the IRS track cryptocurrency? They have a few methods and they're constantly evolving this, but most of them stem around data collection via 1099s, where third parties, such as people that are paying your company or exchanges that your company is transacting on, will send reporting to the IRS related to the transactions activities for you. And then the IRS can match that up against your tax reporting to see if you're under reporting. Similarly, the IRS does a lot of John Doe audits. A John Doe audit is collecting taxpayer information in mass from a centralized exchange that has taxpayer data on many taxpayers. We've recently seen Kraken have a John Doe audit where anyone on their exchange over the threshold of $20,000 had their information provided to the IRS. So again, in these scenarios, if you're under reporting or you're not reporting and you're not in compliance, this is a way the IRS is going to be able to identify that. The IRS also requires you to actually indicate on your tax returns whether or not you have cryptocurrency under the penalties of perjury. So right now, the IRS is collecting a ton of information, and while they're doing that, they're partnering with contractors, crypto accounting softwares, tax professionals to actually take the specialized skill set of doing the accounting and doing the calculations to calculate exactly how much you as a taxpayer may be understating your taxes. So how is cryptocurrency taxed? Overall, I want to make it clear that you need to look at things on an asset by asset basis, whether we're looking at a fungible cryptocurrency like Bitcoin versus a non-fungible asset such as an NFT that's an artwork, or an NFT that is going to represent maybe something else that you're purchasing and representing the ownership on chain. These can have different tax implications versus a CBDC or a governance token or any other type of asset that you may be transacting in. So really, we want to look at the exact asset when we're thinking about tax implications. But in general, cryptocurrency, according to the IRS, is going to be taxed as property. And there's certain tax implications associated with that. So when you're earning cryptocurrency, when you're getting paid in cryptocurrency, usually that's going to be treated as taxable income. You're at the very least going to have your income tax exposure. You may have a self-employment tax exposure depending on your entity structure. So, the first tax that a Web3 company wants to be aware of is income taxes and self-employment taxes. After that, after you're receiving crypto, you also may be selling cryptocurrency. When you sell cryptocurrency, again, because in most cases it's going to be taxed as property, this is going to lead to a capital gains event. So the next tax that you really need to be considering and planning for and making sure you're in compliance for is tracking your gains or losses and reporting your capital gains or losses appropriately. And you want to be very careful that any income is not getting double counted in your gains or losses. And when you're reporting everything in total on your return, you're not overstating and you're not understating any of these items that you're reporting on your return. In addition to capital gains taxes and income taxes, there are additional reporting requirements, and the amount and types of reporting requirements are constantly expanding as the regulatory environment increases in complexity. We've recently seen requirements for companies, if they're receiving over a certain amount of income that's paid to them by someone in cryptocurrency, if they're over $10,000, there's not additional taxes on this, but there's going to be additional reporting requirements for you. And if you don't meet those reporting requirements within a certain time period, there can be significant penalties. So outside of just monitoring the different types of taxes that you may be exposed to, we also need to just make sure that from an informational reporting standpoint to the IRS, to FinCEN, and to any other tax authorities, that we're in compliance with that as well. Lastly, as a Web3 company, if you're selling goods and services on chain, now these can be physical goods or they can be virtual goods, you also need to consider whether or not sales taxes applies to your transaction. One area where we're seeing this a lot is many states have indicated that NFTs are digital products and goods, and they do in fact have sales taxes exposed to them. Washington State is a good example of that. In these instances, you need to be collecting and remitting state taxes to avoid any state and local tax issues related to your sales. So you may be selling NFTs on chain, you may be selling some physical e-commerce good in exchange for cryptocurrency. You need to be properly collecting your customer information and collecting and remitting the sales taxes to the appropriate authorities, again, to avoid any related tax issues and cash flow issues associated with unexpected tax bills. So another very important aspect for Web3 business owners to understand is that when you're managing the digital asset accounting for your company, you need to select an accounting method. This is something you want to work very closely with a cryptocurrency literate CPA on to make sure that all of your considerations are getting taken into account here. Generally speaking, when you're accounting for digital assets, you're going to account for this under FIFO, which is first in, first out. That is the default accounting treatment. Under specific circumstances, if you can meet specific circumstances related to the flow and management of your on-chain funds, we may be able to apply specific identification to certain assets. Now, it's key to look at this on an asset by asset basis and not make a blanket tax election that's not going to stand up to an audit. But the important thing to understand here is that you need to establish a cost basis method and an accounting method that we can track appropriately and substantiate in the event of an audit. So another common taxable event and transaction that we see a lot of Web3 businesses taking part in is actually paying their employees in cryptocurrency. And again, now the tax implications can vary here depending on the type of asset. There's less tax implications when you're paying in a stable versus paying in another type of crypto asset. But two things we want to keep in mind when, as a Web3 company that's paying your employees in crypto. Number one is that if you are paying in Ethereum or Bitcoin or another crypto asset that isn't stable and has price fluctuation, there can be taxable events associated with this. Anytime that you pay someone in a crypto where there's price validity, there's going to be a capital gains event associated with this. So we want to make sure that we're tracking that appropriately. Additionally, when you're paying on chain, you still need to meet all of your payroll withholding, and compliance requirements. So we want to make sure that we're leveraging the right tools to ensure that any on-chain payments related to wages or contractors are going to be compliant. Now, one of the key things to keep in mind as a Web3 business is that audits are won before they begin. And what I mean by that is that documentation is key. Taking the time to be methodical, not only in your accounting, but your tax documentation, is the difference between leaving an audit with no tax adjustments versus having adjustments to your taxes and having your bottom line affected. So what type of documentation is imperative for a Web3 company? Number one is that you need an audit trail for all of your transactions. That means for every gain or loss transaction, every income transaction, every spending transaction, we should have a trail that shows where this asset was purchased, the TX hash associated with the purchase, as well as where it was disposed of in the TX hash of that, to where we can look at a transaction and we can trace that asset all the way back to its inception to be able to document its cost basis and just the overall fact pattern of what happened related to that transaction. Additionally, you want a unified set of financial statements, and you want all of your journal entries related to these financial statements to be well documented. And you also want this to align with any accounting standards that your company has to fit under, which may be GAAP, depending on the nature of your company. So when I say unified set of financial statements, what I mean is that you want your general ledger related to any fiat transactions to be included with your digital asset accounting subledger. And your accounting system that you establish should accommodate this. And we just want to make sure that we're saving all of that documentation appropriately, and we're documenting all of the journal entries, and we know we have a clear documentation from any information that's going from our subledger into our general ledger, and that we have all of this in one place. Additionally, we need detailed tax lot level information on your cost basis data. This is so important, and this is something I see go overlooked so much. You need this information for many purposes. Number one, if you don't want to be captive to a CPA firm or software company that has your accounting data, you want this detailed cost basis information. This is going to be the easiest way for you to roll over your data without reworking any of your past accounting. Additionally, you're going to need that information when you're looking at your tax lots for tax planning purposes, for tax loss harvesting purposes, to estimate your capital gains. This detailed information is imperative to have, and it's something that I see go overlooked. So ensure that you're saving this for your company on a periodic basis in your records. And lastly, you want to make sure that you're documenting contemporaneously all of your tax positions and accounting positions on related to any transactions that may not be fully clear when it comes to the tax code. Contemporaneous documentation goes a long way when it comes to tax audits, especially if the documentation is of high quality. So that is something that you want to work with a CPA that's crypto literate with, and make sure that you're saving this information along with all of your accounting and tax information for audit purposes. So one of the last keys to success as a Web3 CEO or CFO when it comes to managing your tax function is staying on top of tax changes. I foresee the regulatory environment increasing in complexity and a lot of changes coming this year and beyond. We've seen many changes just over the past year with the proposed broker regs, how NFTs are taxed, the informational reporting requirements. A lot of these things are going to be clarified in the future, and there's going to be new regulatory provisions that get passed in the future. So these are items that we need to be aware of, and we need to continually watch for to make sure that we're adjusting our accounting systems and we're adjusting our tax plans based off of any regulatory changes. Are you a Web3 CEO that's looking for an experienced CPA firm that understands the tax and accounting needs for Web3 businesses? Look no further than Camuso CPA. If you need tax or accounting assistance and you want to have a one-on-one conversation about your business, to see where you're at from an accounting perspective and a tax perspective, to see what you need to do to getting accounting system set up and get into tax compliance, contact me and my team today, and I'd be happy to speak with you.